Hi, my name is Mohit Sharma. I'm a senior fund manager with the fixed income investment team. I've been with Birla Sun Life Mutual Fund for last 7.5 years, and I manage several schemes like low duration fund, short duration fund, medium duration fund, credit risk fund, and dynamic bond fund, apart from a couple of index funds. Our objective is to deliver consistent, attractive long-term returns and focus on mitigating the downside risk. We must make good investment decisions to get good returns. At the same time, we must also focus on curtailing the downside risk so that our good returns don't suffer. There are two pillars to my investment approach. First one is heavy focus on research to drive better investment decisions. I track a lot of data, be it domestic macro, global macro, data on external sector, data on fiscal situation, data on liquidity conditions, etc. And on top of it, we run a lot of data analytics on the database that we collect from various sources. The data, when analyzed well, they can give us a good hint on what could happen in the future that helps us in taking our investment decisions. On the technical side, we track a lot of data on the supply and demand on each curve, the spread on each curve, both intra-curve and inter-curve. For example, we would have very long-term data of any issuer, vis-a-vis a GSEC or a AAA PSU curve. So we would know what's been its highest, lowest or median spread, in a very long period of time. This helps us in determining the price of any new issuance that is coming in for that issuer, as well as when we are generally analyzing the market, we would get to know what is attractively priced and what is not so attractively priced. In addition, it is important to be constantly evaluating the market and be nimble in making any changes if the situation warrants. Second pillar is discipline in managing the positions proactively. Discipline helps us in mitigating the downside risk. We don't want any losses to grow big with time, so we have a stop loss at the portfolio level, or at least a partial stop loss, so that we can control any adverse situation. In addition, we have quantifiable limits to control the duration, credit and the liquidity risk in the portfolio. These limits would be slightly more conservative than what SEBI has mandated for that fund category. Portfolio construction process begins with taking an active call on duration view as well as curve selection view. Curve selection means both the selection of curve as well as the tenor on that curve. Duration view is based on the macro research, in-house factor models and the supply-demand analysis. The curve selection view or the spread view is based on credit research, historical spread analysis and the supply-demand analysis. Once these two views have been taken, a little bit of fine-tuning is done based on the liquidity and the carry of the portfolio based on the market conditions. After that, we need to apply the individual limit filters that I discussed slightly earlier so that the portfolio qualifies for our disciplined approach. This concludes our portfolio construction process.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.